you don't really care about that part, but you rather grow faster maybe. Let's say when you do win, you want a big win, wiping away a few losses perhaps, so then you want to focus on the reward to risk. Most traders fall in category 2, by the way, I would say, but it also depends on how you enter at what point. You could enter at an early point, a confirmation point, or as a breakout point. That's late. If you enter early, it's like trading is entering at a fib, for instance. That's an early trade, because at the 61.8 fib, you take a trade there right then, right there. But if you wait for a candlestick pattern, a wick at the fib, that's a confirmation entry. Or if you wait for price then to push away from the fib, but then break a trend line, that's a breakout trade. The early entry would give you a better entry. The confirmation entry would be the second, and the late would be the furthest. But the later you enter, the more confirmation you have that price is doing what you think it was doing or will be doing. There are various ways, of course, that you could, with any entry, you could use a wider or tighter stop loss or wider or tighter TP. In that regard, it's like a three-dimensional thing where you have a cube, where you have here stop loss, tight, medium, loose, and you have, oh no, I should do it differently. You have here stop loss, and here you have TP with the same stuff, tight, medium, loose. So if you put lines like that, sorry, I didn't think about making this graph beforehand, then you can see that you can have a TP stop loss, that's tight combination here, where I have the X, or you can put a TP tight and a stop loss loose. In that case, your R2R is going to be bad because you win less than when you lose, but your win percentage is going to be higher. So in this, let me put an orange circle, a pink circle there, that's going to be high win percentage. Whereas the other pink circle there is going to be a high reward to risk, basically. Because I know a low win percentage, because there's a loose TP, that means a very far TP, a lot of profit, but a very tight stop loss. But not many trades are going to survive that. For every entry method, you could have the same schedule, in a way, if you want to take it very theoretically. This for the early, the confirmation, or the late entry. In general, you could use any type of combination for any of these entries, but I would say typically, if you take the early one, you're looking more at a wider stop loss, because if you're taking an entry at the fib, there's no other stop loss except another fib or the bottom or top. So it's more difficult to put a tighter stop loss. It could be more easier to put a tighter stop loss if you have a confirmation through a candlestick, because then you can use the candle high or low. And if you use the breakouts, you could use even put the stop loss below the trend line break or the moving averages, and that typically is a bit more tighter, I would say. Here are combinations. I've discussed that, in fact, already through that scheme. It's basically a high win percentage or high reward to risk. So you take a trade. Now it's also about the management. You take a trade due to certain reasons, and the environment changes. Let's say there's an uptrend, price keeps pushing up like that, and you take a long, but then price starts to make this all of a sudden. Is it still an environment that you think is matching why you took it at the first place? Does it still make sense to take a long at that spot? Maybe not. Maybe if you look at that particular spot, you would say, I would never enter here, but you still stick in the trade. If you do that, you're more of a passive trade management. It's more of a set and forget, and you don't want to actively manage. If you look at the trade setup and you say, no, I don't want to enter here at this spot, or there's a difference between entering and holding. Obviously, you have three choices. You can enter, re-enter perhaps, or enter the first time. You can hold and wait, or you could exit. Just the fact that you don't want to enter at this spot doesn't mean you cannot hold. But passive is rather not doing anything in the trade management. Active trade management is keep an eye on price and taking action if things develop, either by using a trail stop or market exit, incorporating new info to make decisions, looking at time. Now, if you do that, it's more possible to use a tighter stop loss because then you're able to exit when the market turns against you, or it's easier to do so. If you're using more passive, I would recommend a more wider stop loss because then if you use a passive one, you're not intervening, so you're just letting the trade go. Then there's a chance that the trade will not just react exactly how you want. And in that regard, I think it's more difficult to optimize. If you're using active trade management, it's a bit more doable, I think. So what options do people use? Now, some people have no clue or just use a random stop loss. That's not advisable. But if you start out, that's often what happens. Some people use a fixed number of pips. Others use an ATR. Others use technical stop losses like low, high fractal support or resistance fib levels. Others use time stop. I use a combination of all these things. In fact, that's another option. Maybe not so much the time stop, but I do look at it. And if it shows struggle, it takes too long, then often enough that's a sign of weakness. Technicals are always good. If you use fractals, you can always go 2 fractals away, for instance, by the way. That's always a bit more useful, more safer. You can use swing highs, swing lows, or just normal swing lows or highs. Support and resistance, anywhere you have confluence basically could always be a good thing. Now, even if you use confluence and you use a tight stop loss, it still could be in danger zone, and you still want to be on top of things with exiting. The ATR could give you an idea like what kind of range the price could make, and if you're too close to a high ATR, then that would be an extra indication the price is pretty close to a danger zone. Alrighty, so I would say there may be 3 ways. Let's say passive route, as I said, is trying to not to do too much management. It's a set and forget more. In that case, you're not going to have a tremendous reward to risk, but you can still have a decent win percentage. What you probably want to do is make sure that you just try to survive any sideways or corrections until really price shows that it's going the other way. Then, of course, the unavoidable loss will happen. But you want to make the stop loss easy, not easy. No, I mean, normally speaking, stop losses are easy to hit for most traders. They want to put it too close to price because they want to optimize the reward to risk. And have a tremendous win percentage. But the thing is, we can't have both. But most of the time, I think this is the number one problem, is that traders want both. They want an excellent win percentage, but they want to do it with a 5 pip stop loss. And aim for a 40 pip or make 8 to 1 R2R. So we're not going to have both worlds here. We're going to have to choose. So we don't. In this case, if it's the passive route, you don't want to make the stop loss too easy to hit because it is not going to. You're not going to be able to change anything. So you want to put it in a place that price will have a tough time challenging it. So pretty far away from entry, and you want to put the TP closer. So even if you get less than 1 to 1 R2R, it could be worth it in this case. But you want to make sure that the win percentage is high enough. ATR could be a good idea as well with this passive route, putting it multiple away from your entry. Now, the other route is trying to get in and out faster by riding the momentum, but in this case, you're aiming for a higher reward to risk. And by taking a tight stop loss, one is just ultimately we'll have a lower win percentage. We'll have to be careful that the win percentage is not too low, because it's going to be tough with the stop loss like that, a tight one. And it's possible, but it's just more difficult because you're going to have to manage it more thoroughly. But once again, doing both, having a tight one and aiming for a high R2R without any management is just making it too easy for the market to take one position out. The occurrence, the chance that that happens is just too small. So it's not going to be profitable in the long run. In this case, with the quick in and out, we're riding the momentum. We're trying to, one of the things what can be done is trail stop, put a trail stop loss on the highs and lows. For instance, a 4-hour breakout candle, one could put an entry there, put the stop loss below the candle low, and just trail stop, not maybe every candle, but, well, it could be done, but I think that would be probably leading to too many exits. But let's say the more decisive candles, not putting the stop loss behind every 4-hour candle, because some are small candles and don't mean that much. But any decisive candle, for instance, is something to be thought of, or even fractals perhaps, although that's not really riding momentum, that's more of a trend. Well, even, let's say 1-hour fractals could be a solution. Point is to get the momentum in and out. Don't live through any pullback. Time stop could be useful for that too. If the trade takes too long to break a high, like the 5 to 6 candle rule that I use, if the high of the candle is not broken within the next 5 to 6 candles, get out. It takes too long. For instance, that is a time stop rule one could think of. In this regard, we're not allowing the environment to change. We want one side to have control, to remain in control, and that's it. So one side is in control. Great. And we want to stay in that trade as long as that side is in control. If the other side regains control, we want to be out. That's basically the quick in and out, because we don't know how long that pullback or reversal can last. It could easily take out the stop loss. Maybe not. Maybe we're lucky and the pullback is shallow and price continues. Certainly happens occasionally. So if you think that that environment could happen, fine. You might want to still keep the stop loss maybe at break even. But most of the time, the market likes to move up and down a lot before making a deliberate one-directional move. The other one could be kind of a balance, and case to case, what one decides. Now that's myself. I look at every setup in the live trading room, and for instance, I say, okay, today we looked at various stop losses, tight, loose. I discuss various ones. I discuss various entries and the stop loss combinations in the trading room, and say which one I would choose. Medium, loose, tight, and which TP and which entry. And I let it vary from case to case. One could choose a bit, normally speaking, if I do that, I would go, I tend to go for a bit looser, medium to loose, I mean like bigger stop loss. And one could also go for, you could play around with this trade management. You could have a higher target, but then still take a market exit if there's struggle before the target is hit, and use a loose trail, for instance. Try to find, of course, those setups with higher probabilities and decent R2Rs. Obviously, those were the best ones, but you can't have it perfectly, as I said. Other things I thought of, place the stop loss. I like to place the stop loss on the uneven numbers, by the way, and I like to go beyond highs and lows by 5 to 25 pips, roughly. So not exactly to the pip above or below a high or low. I like to give it some space. So that is some things I thought about when making this presentation. Now, I have a feeling that somewhere in the back of my mind I was searching for something that I have a feeling that I wanted to share with you, and I have a feeling I missed. But if I do think about it later, I will definitely let you know next time. But basically, it's never going to be perfect. Be careful of the tendency to put it too tight, unless you have, of course, extensive experience with putting a certain stop loss that you use. That's fine. But I'm just saying that most of the time, traders that start out, have a tendency to use tight ones, so be careful of that. If you have a looser one, maybe you have the problem of living through a drawdown, or sorry, not a drawdown, a pullback, but maybe that looser one allows you to survive that trade and still hit the TP, for instance. So think about it at least. Try to find that balance. Think about also how you want to trade manage it. And when you look at your results, go back to your evaluations and your old trades and try to look at the balance between the TP and stop loss, and try to live through the trade. Try to see why the trade was a win or loss. What did you have to live through that win or loss, and how a different stop loss or different TP would have influenced those trades of that week. And see if a different combination maybe would have been a better solution for your trading. Maybe it would have given better results. And keep that in mind for the future. And evaluating like that never can hurt. Does anyone have any specific questions for myself at this point? This is the Aussie, for instance. And often enough, you would see me, for instance, here on the 4-hour chart. I was saying wait for a breakout. So with this breakout candle, an entry could there, a tight stop loss would have been above the candle high, and trail stop at each high. A looser one, right here, I want write this entry right here, where I have the red line and this blue line. A looser stop loss would have been above this top, this fractal, or even above this top. But then you have to, if you use a loose stop loss like that, you probably are going to try to lift this pullback for the follow through, unless you had a TP here and it got hit. If you use a tight stop loss and you enter at blue and you have a stop loss at green, okay? What's happening, basically, in this case? Let me get rid of all of this so you can see it. If you enter at blue and you have a stop loss at green, the trade goes your way, and let's say you don't take profit. Although, of course, you should if you're up 95 pips versus, in this case, an extremely tight stop loss of 22 pips. So you're up 4-1. I don't think anyone would do that. But let's say, for the fun of it, no one does anything. Or you enter later and you have a stop loss like this. Your stop loss is indeed exactly within the swing level. Great job, Joe. And in danger. But even if it's outside of the swing level, swing high, swing level, price can always break tops and bottoms. And sometimes we trace bigger swings and highs, swing highs and lows. In this case, indeed, the pullback didn't break this top or this top. But even that sometimes, you see price go up and then still down like that. And even a good technical stop loss could have sometimes get knocked out. So indeed, if you don't exit on time, let me say it this way, then the market's probably going to get that. In this case, by using the trail, you would have exited somewhere here and netted some profit. Although you probably should have used a TP as well with a tight one like that. If you use a loose one, you're probably not going to have the R2R, but maybe you would to exit at the bottom here. But if you hang in, you would have to live through the pullback and hope that the bear gain control. and either have a TP ready, lower spot, or designate the spot. There are a lot of trade management things that we can think of. Let's say you only trail stop when the trade is up by 2-1 or 3-1, and that's when you start. When this price hits this orange line, that's when you trail stop the candle highs. For instance, you don't have to use immediately a tight stop loss when you have a wider stop loss. You don't have to use a wider trail stop, sorry. So as long as you're aware of where the stop loss is, where entry is, where TP is, and the space that's connected to it, and how you approach that, and you're aware of what you might have to go through, live through, and how you want to approach the management, then you'll have a better orientation of the playing field. All right, so sorry for all that text before that. This is, maybe I should have gone to charts before, but this is kind of exception. This is on the chart what I wanted to say with the text of the slides before that. So with that said, I am going to pass over the presentation to Nenad. Let me see if he's around.
Yeah, Chris, everything is okay. Thank you for your presentation.
Great.
Great.
Let me give it to you. Yep, thank you too.
Okay, guys, now we can continue. Thank you, Chris, for such a lovely presentation. I will show you some different methods on how you can calculate your stop loss, and I will use this opportunity also to remind you to watch a webinar about multiple time frame trading, where I already explained this stop loss method, which sounds pretty much good if you want to use it. So let me start with my presentation. So what is a stop loss, advantages and disadvantages, and new methods on stop losses? Just let me remind you a little bit what basically a stop loss is. So everyone know what in theory a stop loss is, but the thing is that maybe some of you don't know that when we close a sell order, it's an automatic buy into the market, and vice versa. That is why we saw such a big spike today on GBP dollar and euro dollar. Basically, it's called profit taking. So when close of sell order is done, what your platform does, and you cannot see it, is basically that it gives an automatic buy into the market. So that is why when most of the traders are closing their shorts, what will happen is the price will spike up. And definitely that happened today with the GBP dollar and euro dollar, and that is why we basically saw a big upside reaction on both pairs. So remember that when you close a sell order, it's an automatic buy into the market. That can also give you a sentiment. If you remember today, I made a post on Twitter saying that euro dollar fell some 30-40 pips of our predicted level since our last recap. If you remember, I gave you sell around 24.40, and what happened is euro dollar fell to 24.0 something today. And I just saw that it might be a possibility because US GDP was pretty much fine, advanced GDP, it was pretty much fine, but euro dollar just basically it didn't have a knee-jerk reaction. It started to fall, then it was basically bought off again. And I suspected then sell orders could be closed, especially because we have Thanksgiving, we have profit taking soon, and also Japanese banks were on holiday last night. So what I suspected is we might see some limited profit taking, and that is what happened. Price was falling, and then most of the traders closed sell orders, and then it was automatic spike. What happened is 64 was broken, it collected some stops to 88 level, and basically now the price is still close to that level, so we'll see what will happen. But the thing is, it's always when we close a sell order, it means an automatic buy into the market and vice versa. Stop loss is executed at given price, but if the market is very volatile, you can experience a slippage. That means that basically if you put your stop, let's say at 24.65, it didn't happen, but just theoretically, when stop loss was hit, instead of closing your order at 65, it might be closed at 70. So that's called a slippage. It happens when market is very volatile, and usually on the strong news, you can basically experience a slippage. Stop loss in its own sense means stopping the loss. So that's why we call it stop loss. So it means it serves you to basically protect your profits. So it's safeguarding your profits. That is why we call it stop loss, stopping the loss. The advantages of usage of stop loss are: we are protecting our equity, then not using it on leverage trades can end our career in Forex market. That's especially true if you basically do not want to use stop loss and you're trading without placing a stop loss. Quick exit of the trade when it goes below or touches the stop loss means peace of mind, because peace of mind is what you need if you want to effectively trade Forex market. It's also disconnection proof. So if your platform disconnects and you're having, let's say, a blackout or brownout, power outage, then it will basically be hit later, saving you from a further loss, because your order is placed on a server, not on your computer. It's also platform malfunction proof. If your MT4 for unknown reason stops working, it will basically be again executed because it's placed on server, not on your platform. Disadvantages: brokers' awareness of stop loss orders. Some brokers basically made some money with spiking stop losses some time ago, but fortunately enough, it's not the case really with Admiral, and I don't know if some brokers use it, but the thing is, back in time, that was maleficent practice. Psychological failure when stop loss hits and reverse. Of course, there is big disadvantage, and I really hate to see it when it happens. Your stop loss is hit and then price reverses. So let's say you were short from here, your stop loss is hit to the pip. The price didn't make any pip after your stop loss was hit, and then it proceeds further down. That is why I don't like really to see it. If stop loss is placed in a wrong place time, definitely. If you place it on a wrong, yes, and what John is saying, if you're using a trade manager software, the stop loss may be on your computer. Exactly. But if you're using a stop loss manager, I presume that you use a trailing stop, right? So basically, before placing trailing stop, you need to put a technical stop, right? Of course, if your trade manager software is putting stop losses for you, that may be misfortune if platform, your PC, experience some power outage or stops working, because then your manager software would not place a stop loss. The thing is how I do it. If I use trail stop manager, I always put my stop loss in the first place and then I let it manage it. Because the first thing when I open a position, the first thing I do is I'm putting a stop loss, always. And I just prefer to have stop loss because it really can save us and save our accounts from different things which we not have an influence to. Also, if you don't know where to put your stop loss and you're putting your stop loss randomly, you might experience so-called death of 1,000 cuts. That means constantly trading with small stop loss that gets hit each time or multiple times position is open. So let's say you want to scalp, you put your stop loss on 10 pips, your stop is hit. Then you put stop loss of 12 pips, again your stop is hit. But you see the price is going up, hits your stop loss, then reverse. Again, price is going up, hits your stop loss, then reverse. It's called death of 1,000 cuts. You should not trade with small stop loss. As Chris already explained, it's stupid to look for 10 pips of I don't know, a stop loss and trying to get 100 pips. If I see that some traders do it, I would definitely think they're not serious, because most of the time, 95%, 96% of the time, even more, they would lose, because when market is volatile, it will hit 10 pip stop loss and then proceed in your direction. So that is why you need to be flexible with stop loss. And if you're flexible with stop loss, then basically you know how to trade with low risk, right? Which are new methods for placing stop losses? I will show you ATR stop, percentage stop, time stop, and confluence stop. These are some of new methods for stop loss placement. Let's start with ATR stop. So add high ATR to low ATR. Multiply with 25, place it above MA or that candle's high low. So this is the primary rule for ATR stop. You should open your ATR indicator and place a period of 14. So it should look like this. ATR 14, it would have this line, but you're not interested in this line. You just want to see high and low. In this example, high is 68, low is 23. So what you do is add 68 to 23, basically. Add 68 to 23, it gives you 91. Then you multiply 91 with 25%, and it's basically giving you 23. So that is 23 pips. So where you should put your stop loss? 23 pips per spread, above, let's say, SMA, or above candle high if you're going short. You can see this example. This is 15-minute chart. We have a randomly chosen SMA. High of ATR is 14, low is 33. So high plus low is 17. You multiply 17 with 25%, and you will get 3.9. We always round the numbers out. So we have 4. So we should place, if our entry is here, let's say we should place our stop 4 pips above last high or this EMA in the moment of entry. Okay, so let's say that we have opened our position here on this candle. You should place your stop 4 pips above EMA or 4 pips above last candle high. In this example, if you place it 4 pips above EMA, that means that we are using aggressive stop loss placement, and if you place it 4 pips above last high, then we are using conservative stop loss placement. Okay? That is how it goes with ATR stops. So once more, add high or ATR high to ATR low. These are two numbers which are displayed on your time frame of entry. So if you're trading 15-minute time frame, you add 14 and 3. That means it's 17. You multiply with 25%, you will get the number. Add that number above or below last week high low or SMA. Now percentage stop. Percentage stop is basically, it uses predetermined percentage of trader's account. So let's say that you want to risk 3% in a single trade. With this method, stops are usually small if trades are leveraged. Let's say that you want to take on 10,000 account, you want to take, let's say, 1 lot trade. And basically with 1 lot trade on $10,000 account, on most of the pairs, your stop loss would be 30 pips. So if you want to trade, with predetermined percentage of your account, that means that you will always have predetermined risk. So if you're risking 2 or 3% per single trade, then you will be definitely risking that percentage, and you don't know how big your stop loss is. You only know that you can only risk 3%. There are no many entries because you're using a percentage stop. You will usually use a single entry. Okay, not many traders do that because it's arbitrary stop loss. So it's definitely a subjective stop loss, and traders don't like to use it. But still, if you want to use it, typical stops are 2% for intraday trades, 8% for intra-week trades, 15% for monthly trades, and 20% for investments. So let's say if a long trade is entered, let's say 1.250, 2% stop loss would replace it 1.225, 25 points lower than the entry price. So that is how percentage stop traders are basically calculate that stop loss. So 2% of 1.250 is 1% 225, and that is 25 pips lower. So 8 for intra-week, 15 for monthly, 20 for investments. Usually monthly, yearly trades. This is how those traders calculate their percentage stop. Time stop is always based on a predetermined time. It can use a candle close for 1 hour, 4 hour daily. It also is applied prior to big news or weekends. Now, what is time stop? Let's say that you were long in this particular time. And let's say that you were long from this point in time. And let's say this is 1 hour chart. You know that 1 to 3 hours from your entry, some major news will kick in. That means that you will close your trade here at this candle, no matter whether your trade is in profit or in a loss, because you don't want to risk anything. It's called time stop. When this candle closes, I will close my order no matter how good it is or bad. So you made your entry here, price was spiked. Here at this point, this candle closed. You know that after this candle closes, in some couple of seconds, you will see news reaction. So you close your trade here just because there was news afterwards. Time stop is based on a predetermined time. It can use a candle close. It's applied prior to big news and no volatility. So if you want to use time stop, that you can do that on Euro Swissy, because Euro Swissy, as we know, should be defended from 1.2000 levels, and you can say, okay, my time stop will be day after gold referendum. So I might close my trade. So basically those are some examples, but usually those who trade time stops are traders who do not want to risk anything prior to big news, weekends, and some special time frame happenings. So let's say that you trade 4 hours, this is, let's say, daily time frame. Those traders will definitely close their trades after the candle close, because every single day there is big news. So that is called time stop. Last stop is also one of my favorite stops, but as you already know, it's a sort of price action stop, and it's definitely have to do much with so-called price action stop or confluence stop. You need to know how to use chart lines and Fibonacci's trend lines. We also use pivot points, and we definitely determine the best confluence. Usual stops on intraday 1 hour charts are placed 5 pips above the confluence points. So let's say this is one of the charts, and blue square marks an entry. So this is my entry. This was my entry. Now, if I want to trade this entry, I need to look at possible aggressive or conservative stop. I can see a trend line here, but I can also see 78.6. What I would do is I would definitely place my stop 3-4 pips above this confluence point. I have 2 points of confluence here. We have basically trend line and we have fib number. So this is a confluence. I made my entry here. I can see confluence. I would put my stop loss 3-4 pips above this line. If I would go conservatively in the trade, I would basically expand my stop loss above this confluence point. What sort of confluence do we have? We have 88.6. We have a trend line thrusting through this historical level of support and resistance, and we basically have a Fibonacci number. So this is also triple confluence. So pay attention once more. This is how I usually place my stops, but usually my stops are fixed, something in between 30-35 pips. But this is how I like to place my stops. Okay. Confluence points. I'm looking for a confluence. I have trend line. It is A. Then I have B, which is basically fib number. Aggressive stop loss placement is placing 3-4 pips above this level here, above this high here. And we have also H5, which is basically Camarilla, pivot point indicator. So we have triple confluence. First part of triple confluence is trend line. Second part is basically, let's say 78.6 and this one. And third part is trend line. So definitely what I would do is place my stop 3-4 pips above this 78.6. If we want to go conservatively, then we have two additional confluence points. C, which is longer term trend line, and basically we have a D, which is historical support resistance level. So I would definitely place my stop loss here. But I usually want to see it a little bit lower. So that is how you calculate your confluence stop. So guys, these are all methods, maybe some new methods for you. This webinar is recorded. I really hope that it will be uploaded. So this is everything which we have prepared for you today. It is pretty concise, pretty much clear. I want you to try to practice with this kind of stop loss. So ATR stop, guys, try to practice it. Try to practice. I don't advise particularly using percentage stop, but time stop is basically what we, yeah. Yes, no. Gold referendum should be voted no, and I expect that definitely, no matter what happens on Euro-Swiss referendum, SMB will defend 1.200 because it's of their national interest. So I will leave my trade. Yeah, I know it sounds risky, but I really count on SMB possible intervention if it gets too close to 200. And I think that the referendum vote will not pass. People will vote no. That is my opinion. Yes, definitely. And I expect Euro-Swiss to rise at least to 2100, but I would like to see it even more up. But 2100 will be the first resistance. So try to experience this. ATR stop, percentage stop, not particularly this, but some traders do that. Time stop and confluence stop. I advise you to try to experiment on ATR stop and especially confluence stop. I like to use confluence stops. So this is everything we had for you today. I hope that you have enjoyed our webinar. As always, sign in for recap and for Chris live webinars. We had particularly something around 60-70 pips so far on euro dollar and GBP dollar combined, and I hope that we will keep making nice pips after each recap. And thank you guys for listening to me. Thank you for watching this webinar. Experiment with these kind of stops and try to see what it suits you the most. Thank you, and I will talk to you soon. Cheers and trade safe.